Jobs growth slowed to a crawl last month.
The U.S. job market looks increasingly fragile. This report just moments ago shows the U.S. economy added 22,000 jobs in August. That is very low. It's also
22,000 jobs. That's it. Against the 75,000 that was expected for August. In a single headline, in a single moment, the entire market flipped. Stocks dumped, bonds ripped, and suddenly traders were no longer pricing 25 basis point cuts. Instead, the odds of 50 basis points started climbing higher. So here's the real question. Is the Fed about to rescue this market or set the biggest bull trap retail traders have ever seen? Back in late July, I said the Fed would most likely cut by at least 25 basis points sometime in September or October. But I got a lot of hate for my opinion in that video. Well, what do you say now when the odds of 50 basis point cuts are jumping higher? In this video, I'll walk you through why this matters, what history shows, and what's coming in the next 2 weeks with CPI, PPI, and the Fed's big decision, plus what it means for you as a trader, and most importantly, how you should be thinking about positioning heading into this mess. Quick note, all the technical levels and trade setups will be in the newsletter. Speaking of which, if you've been following the newsletter, you've seen my calls. Apple, American Eagle, Centene, United, Gold, Neo, Reddit, and many more, all played out as I laid them out. If you're tired of chasing trades and getting chopped up, this is built specifically for you. Twice a week, I send out free weekly market playbook with the exact charts, levels, and setups that I'm tracking. Things you won't see on YouTube. Hundreds of traders already use it to stay ahead. Don't be the one left behind. Link is in the description below. Alright, let's get into this. Heading into the jobs report, most traders expected a soft print, maybe a mild slowdown. Instead, we got a shock. Non-farm payrolls came in at 22,000 versus the 75,000 that was expected. The unemployment rate ticked up to 4.3%. And when you dig deeper, it looks worse. The US lost 357,000 full-time jobs while adding 597,000 part-time jobs. That's not a healthy rotation. That's people taking what they can get. The cracks had been forming all week. ADP payrolls came in at 54,000 against the 73,000 that was expected. Jobless claims ticked up to 237,000 from 230,000. And JOLTS showed weaker demand for workers. Add in the downward revisions that erased 160,000 jobs in June, and you see the picture. The labor market isn't just slowing, it's deteriorating. And there is another shoe set to drop. The BLS is about to revise job numbers for the year ending March 2025. And Goldman Sachs estimates it could be as much as negative 950,000 jobs. This is the biggest downward revision since 2010. And the market wasted no time reacting. Bonds ripped higher, yields dropped, and rate cut odds flipped. What looked like a sure 25 basis point cut is now a real debate about 50 basis points. At this point, traders are treating at least one cut in September as guaranteed. Hedge funds are placing their bets too, with short positions in S&P 500 futures hitting about $180 billion. This is the most since 2023. That's big money saying they don't buy this rally. Stocks told the same story. Thursday's rally didn't last. By Friday, it was overraised. The market's hinting, sure, a cut might be coming, but not for the reasons you want to celebrate. Zoom out and the bigger problems come into focus. The ISM Services report showed its employment index at 46.5, meaning companies are cutting back on hiring. At the same time, prices paid jumped to 69.2. Proving inflation isn't gone. If you've been following me for a while, you know what's coming next. Stagflation. I've been calling this for months now. We'll cover how to position for that in a moment, so stay with me. Meanwhile, the underemployment jumped to 8.1%. This is the highest since 2021. On top of that, consumers are feeling the squeeze. Credit card delinquencies are the highest since 2010. Household debt is at record $18.4 trillion. And confidence for households under $100,000 has fallen back to 2020 level. And while families are stretched, Margin debt just hit over $1 trillion. It feels like we're breaking records everywhere you look, but for the wrong reasons. And here's the kicker. Retail traders are still piling into tech. JP Morgan says flows into Mag 7 plus Palantir hit $50 billion this year. Nvidia alone took in $20 billion. Tesla and Amazon another 13 and 10 billion. Retail keeps buying the story while hedge funds quietly faded. Sounds familiar? It should, because it looks a lot like 2000 and 2007 all over again. History gives us perspective. In 2001, the Fed cut aggressively as job losses mounted. Stocks bounced short term, but the recession still hit. In 2007, cuts started while payrolls weakened. Markets liked it and they rallied, but credit stress soon overwhelmed it. Even in 2019, cuts were framed as insurance. Markets liked it until 2020 forced emergency move. The pattern is clear. Rate cuts might buy some time, but they don't solve the problem. If you want to see the bigger picture I've been talking about for months now, the parallels between today's AI mania and the dot-com bubble, go back and watch my video from a month ago. It will give you a context for why this market's reaction right now looks so familiar. So, how should you prepare? Volatility will only rise into CPI, PPI, and the Fed on the 17th. That means keep positions smaller, know your stops, and don't over leverage. Don't chase every green candle. Ask why it's moving. If the only driver is Fed cut hopes, remember, cuts don't fix weak jobs or rising debt. That's exactly why it makes sense to look at where the opportunities shift. In stagflation, with weak economic growth, sticky inflation, and a Fed that is forced to cut, commodities, oil, and energy tend to outperform. They move with inflation, while overstretched tech usually takes the hit. Right now, commodities outside of gold are the cheapest they've been versus gold since 2008. And historically, that gap doesn't stay open for long. If it were me, I would hedge tech, maybe take some profits, and start eyeing those inflation-linked areas. Long-term holders can ride it out, but active traders should focus where the odds are better. And don't forget it, I'll keep everyone updated through my newsletter as these opportunities unfold, so make sure you're on it. Alright, let's shift from the market story to what's ahead. Here is what's on the deck for this week. On Monday, September 8th, we have consumer credit. On Tuesday, we have NFIB index. On Wednesday, we have PPI. On Thursday, we have CPI plus jobless claims. And on Friday, we have consumer sentiment. All eyes will be on Wednesday's PPI and Thursday's CPI. At this stage, those reports are less about surprises and more about confirming whether the Fed moves by 25 basis points or goes bigger with 50 basis points. Either way, a 25 basis point cut in September feels basically locked in. And less than 2 weeks from now, September 17th, we get the Fed's rate cut decision and Powell's press conference. That's the one that the market is already trading towards. Now, let's move from the macro to the micro. Earnings are lighter this week, but we still have some big names to watch. On Tuesday, we have Oracle, GameStop, and Fuel Cell Energy. On Wednesday, we have Chewy. And on Thursday, we have Kroger and Adobe. This won't move the whole market, but they can give us a read on software margins, consumer spending trends, and overall risk appetite around AI. Okay, to wrap this up, the Fed doesn't have much room left. With jobs weakening and inflation still sticky, the market is now split. Are these cuts going to stabilize things or trigger the kind of bull trap that leaves retail holding the bag yet again? The next 2 weeks, CPI, PPI, and the Fed will tell the story. Don't get caught chasing. Make sure you're prepared for what's coming next. If this breakdown helped, hit like and subscribe. I do this every week. And don't forget, the free newsletter has the setups and levels I didn't share here. Link is below. And I want to hear from you. Do you think the Fed goes with 25 basis points or 50 basis point cuts? Drop your thoughts in the comments below. I read everyone. Thanks for watching, and I will see you in the next one.